Greetings once again, and thank you for your continued interest in the really hard accounting course. And today I've got a special presentation for you that is going to drive advanced accounting professors around the globe crazy. And for those of you working in industry or public practice, this may make your life a little easier when it comes to preparing simple consolidations. In this video, I'm going to share with you a simple Excel-based consolidation model that I've designed to help you standardize your understanding of consolidations. In my experience, with teaching advanced accounting, students very easily get confused by all the means and methods that various problems use. Many of these solutions use the so-called direct method of preparing the consolidation. That is a method whereby each line is individually adjusted to what it should be. The problem I have observed is that many students can never get their draft consolidated financial statements to balance because either they miss out on one side of the adjustment or they have their debits and their credits mixed up. It's easy to do, and I won't lie to you, I've been working on this template myself for several weeks. If you haven't already done so, you can download a copy of the Excel model from the FinanceLearningAcademy.com. Let's just take a moment to show you where you can do that. So once you're on the FinanceLearningAcademy.com, you can find the Really Hard Accounting course under the Mastery Courses section of the website. And once in the Mastery Courses section of the website, you can navigate to the actual course itself using the left-hand navigation toolbar. And on the course page, you can look at the right-hand content area of this page and find under the Resource Center the consolidation template. You click on the link, it asks you to download a file, and away you go. So let's start with the end in mind. What does this monolithic spreadsheet actually do? Well, you input the various pieces of information you have gathered from your parent and subsidiary corporations into the relevant cells, and it will automatically prepare for you a consolidated trial balance. And I'm assuming that everyone is comfortable with drafting financial statements once you have a trial balance. That's not actually part of the Really Hard Accounting course. The model also provides you with the continuity schedules and the reconciliations to prove that your consolidation works. Let's take a look at this puppy and see what she can do. Yeah, I know what a lot of you are probably thinking right now just looking at this spreadsheet. Holy crap, this is a lot of information. I will be the first to admit that I'm kind of a geek when it comes to the Excel, and this is nothing compared to the financial model I once built that maxed out Excel. But that's another story. Let me break this down for you quickly to alleviate your hyperventilation. Notice this slime green shaded cell up in the upper left-hand corner of your screen with the blue font. Cells with this type of shading are the input cells, and this is where you put the information you have gathered from the parent and the subsidiary. All the other cells are formula cells, which you should not have to touch unless you have a problem or a situation that hasn't been contemplated by the template. For example, if you only want to take a half a year of amortization, or if you only want to take in a portion of the year's financial results from the subsidiary, well then you'll have to lift up the hood a little and adjust the formulas yourself. It's all open code. The next thing you need to note is that I've consistently used positive numbers to represent debits and negative numbers to represent credits. So keep this in mind as we work our way down through the spreadsheet. The top portion of the spreadsheet is basically a consolidation worksheet. You begin by inputting the financial statements of the parent and the subsidiary in columns B and C. You may need to aggregate amounts into a single row in order to fit the form, but you'll get the idea. All the columns to the right are the consolidation entries, which can be broken down into three sections. Column D records the acquisition. Columns E and F adjust for the equity earnings and the non-controlling interest for the years between the date of acquisition and the beginning of the current year. Of course, this assumes that the parent is using the cost method of accounting for its subsidiary. I have another template developed for when the parent uses the equity method. Columns G to T pick up the consolidation adjustments for this year's activity. Notice the descriptions in rows 3, 4, and 5 to help you identify what each column is for. Row 6 references you to a supporting schedule. The supporting schedules are below the worksheet, and we will go there in a moment. Column U simply sums up the consolidation across each row, In other words, it posts the consolidation entries. Notice my starting point is a combined statement of the parent and the subsidiary. There are a lot of ways to do a consolidation, so there are other ways to arrive at the same answer. Now, column V is a kind of a free-form column. If you know the answers or you have reconciling schedules of what the balances should be, you can input these numbers here and use them to compare to what the calculated amounts are using the worksheet. I have a few reconciliation schedules already prepared for you for the likes of deferred taxes, retained earnings, and minority interest. And as we move down the worksheet, you'll notice at row 38, it shows you the net income impact. Note that this line ultimately becomes the parent's allocation of the consolidated net income, and not the consolidated net income itself, which is on the line below that. The non-controlling interest allocation of the net income is included on row 36. You'll also see that I've embedded little notes throughout the spreadsheet to help you fill it in, but I'll leave that for you to explore. Below the worksheets are the all-important schedules and detailed reconciliations. Schedule A calculates and allocates the purchase price discrepancy. And I've seen this called the purchase differential as well as the fair value increments. It all means the same thing. One important little nuance of note. International accounting standards, and the US standards for that matter, use the entity theory for consolidation. And this means that all the assets and liabilities of the acquired subsidiary are reported on the consolidated balance sheet at the fair value at the date of acquisition, not just the parent's entitlement. This includes goodwill. This implies that the value of the non-controlling interest must be valued at the date of acquisition as well. Where there is no separately determinable value of the non-controlling interest available at the date of acquisition, the non-controlling interest is valued using the same proportional valuation as was paid by the acquirer. However, where there is objective evidence of the value of the non-controlling interest, say if the company was publicly traded, this amount is the preferred means of valuing the non-controlling interest. The template is set to calculate both. If you leave the market value cells blank, it reverts to the implied value. Moving along, Schedule B tracks the reversal and amortization of the purchase price discrepancy amounts and goodwill. Schedule C through G tracks the consolidation adjustment items for things such as profit and inventory, land gains between affiliates, or gain and losses on the sale of depreciable assets, and finally, straight eliminations of revenue, expenses, receivables, and payables between related companies. Note that Schedule F1 and F2 for depreciable assets is for the intercompany sale of assets that are depreciated, whether they are tangible or intangible, for example, a patent. The worksheet mashes this through all in one row, so you may need to reallocate that a bit in your final draft of the financial statements. Schedule H reconciles your deferred tax account. It does not pick up on any taxes on the loss carryforwards at the date of acquisition. This too will need to be separately considered and manually adjustment if this is applicable to your circumstances. Schedule I is important, not to mention daunting. Schedule I reconciles each of retained earnings, non-controlling interest, and the investment account had the company used the equity method. I've done all three on a side-by-side basis to allow you to see where the differences are and which accounts pick up which adjustments. Unfortunately, given the number of potential adjustments in any given situations, the reconciliation can get a little unwieldy at first glance. The top part of the reconciliation deals with the opening balances, i.e., all the activity since the date of acquisition. As we move down to the bottom portion of this schedule, you can see that the bottom part of the reconciliation deals with reconciling the current year balances. There's a lot of good learning in here, so make sure that you understand what adjustments are necessary and where the numbers are coming from. Note that you don't have to enter a single number into this reconciliation. And last, Schedule J is just a quick reconciliation of the ending non-controlling interest balance. It should agree to the reconciliation on Schedule I. Now let's populate this template with some data and see how and if it actually works. Now the data is presented to you in the pinkish box on the right hand side of your screen, and this is the information that we've gathered from the parent and the subsidiary about the acquisition, the current year financials, and the intercompany activity during the year. Now we can fill in the slime green cells with this data. So to begin with, we'll enter the financial statements, For cash, we had none. We had $36,000 of receivables and notes. We had $66,000 of inventory, $150,000 of land, $220,000 of depreciable assets. We also had an investment in the subsidiary of $84,000. We have bank indebtedness and current liabilities of $90,000 each. These will go in as a negative number as they represent credit balances on our trial balance. Same with our $150,000 of common shares. And our retained earning balance at the end of the year was $226,000. We'll have to come back and adjust this to figure out what it should have been at the beginning of the year. Again, I draw your attention to the comments that will guide you in preparing the template. When we go down to the income statement, we have $798,000 in sales. Again, it's a credit balance. We have $24,000 in management fees, as well as $14,000 in investment income. We have cost of sales of $480,000. We have other expenses of $40,000, $106,000 of depreciation expense. We have $10,000 of interest income and income taxes of $80,000. That gives us our net income. You can see the $120,000 balances, but our trial balance doesn't balance. So we know we have to go back and adjust our retained earnings for the amount of the current year's income. We may also have to subsequently adjust this for any dividends that the parent may have paid as well. But for the time being, we now have a trial balance that balances. The subsidiary's information will get input as follows. So the subsidiary actually has $10,000 in cash, $70,000 in receivables and notes, $44,000 in inventory, $30,000 in land, $76,000 in equipment. And then under the liabilities, they have $60,000 in payables, and they have $50,000 in common stock, and $120,000 in retained earnings. On the income statement, they have $300,000 in sales, and they have some investment income of $3,600, so minus 3.6. And they have a little bit of gain or loss on some land that they've sold of $20,000. So that's again a credit balance. We enter our cost of sales of $200,000. They have other expenses of $12,000. They have depreciation of $31,600 and income taxes of $32,000. Giving us a net income of $48,000. It agrees. Once again, we have to adjust our retained earnings for that income. So we'll just add that back. And lo and behold, our trial balance now balances, and we're ready to start inputting information. We input 5 into the cell at the top, indicating that the current year is December 31st of year 5. We're now at Schedule A, which is where we input the information about the parent's acquisition of the subsidiary. So here in the first cell, our ownership percentage is 70%. Our consideration, again, there's a little note here. We either indicate we paid cash or share consideration. We paid cash consideration. We now indicate how much we paid. We paid $84,000 to acquire our 70%. If we had fair value information as to what the value of the non-controlling interest was at the date of acquisition, we would input it in this little table to the right. Since we don't, we're going to go with the implied value. We then input the subsidiary's net assets at the date of acquisition, which was $50,000 for common shares, retained earnings of $30,000, giving us a purchase price discrepancy of $40,000. And now we'll put in our fair value increments. Our inventory had a value $9,000 less than the carrying value, so we need to adjust that down. So we'll have to credit inventory by $9,000 to get that down. And our equipment was worth $24,000 more than the carrying value, so we'll have to mark up inventory by $24,000. This results in goodwill at the date of acquisition of $25,000. So there's our purchase price discrepancy at the date of acquisition. Let's move on. Schedule B is where we fill out some more information. The date of acquisition gets filled in here. We note that it was January 1st of year 2, so we're just going to put in 2 to indicate that it was year 2. The rest of the columns fill in automatically for us. Our inventory, the amortization period is how these initial fair value increments will reverse or amortize over a period of time. So inventory is going to reverse within 1 year. So it presumably all that inventory is going to be sold in the year following the acquisition. So we want to amortize that over 1 year. However, the depreciable property will amortize over its remaining economic life of 6 years. So we'll adjust for that. And then finally, we make a note that goodwill has been tested for impairment each year, and the recoverable amount of goodwill at the end of year 5 is $3,500. So we are going to have to go over to the year 5 column, which is the current year, and make an adjustment. We currently have $25,000 of goodwill, so we're going to have to adjust this downward. You notice that goodwill has been broken out between the parent's portion and the non-controlling interest. And again, so you have to proportionally adjust it. So we know that it's got to go down by $21,500 to get that to equal $3,500 in recoverable amount. So we're going to say that 21.5 times 70% is going to belong to the parent, and we'll have to make that a negative number to make that go down. And then we'll have the same sort of thing here, 21,000 times 5 times 30% for the non-controlling interest, which should give us our $3,500 recoverable amount. If I adjust that for my decimal places, and there's our $3,500 recoverable amount. Okay, so let's keep going down the schedules and move on to the intercompany profit eliminations. So here we are down in the intercompany profit eliminations. We can see that from our trial balance or our financial statements that we have a 40% statutory tax rate. Let's put that into that cell. And then we can take a look at it. It says parent charged a subsidiary management fees of $24,000. That information would get as a straight elimination and would get entered into Schedule G. So there's management fees of $24,000. The next one says parent sales to subsidiary of $100,000 with a 35% gross profit. So parent to subsidiary, a P to S sale of $100,000. And subsidiary still held $30,000 of inventory. Profit and closing inventory, where we have a downstream transaction, the parent was the seller, would equal $30,000 times 0.35, which would be the gross profit. That would have to be deferred on a consolidated basis. So next, it says that subsidiary sold land to parent for a gain of $20,000 on April 1st of 2005. This is an upstream sale that occurred in year 5, and the amount of the gain was $20,000. And then finally, it says the parent signed an 8% note payable for $40,000, presumably to pay for the land. So once again, we have to go over to our section of the straight eliminations, and we'll input a note receivable of $40,000 due to from, which needs to get eliminated, as well as interest. So I don't know what that works out to be, but interest on $40,000 for 9 months times 8% gives us interest of $2,000 that needs to be eliminated on that note. And there we have it. And you can see that there's no more items for us to fill in the slime green cells as we move our way down. And therefore, our consolidation is now done. Let's check this out. If we go back up to our consolidation worksheet, you can see in the first column, column D, we've recorded the acquisition, which comes from Schedule A. Schedules B and C pick up our equity earnings and purchase price discrepancy amortization since the date of acquisition to the beginning of this year. Column G picks up the non-controlling interest allocation of the current year's net income. H adjusts for our amortization of our equipment purchase price discrepancy, and our goodwill impairment has been picked up as well. And you can see those flowing through the income statement. There was no subsidiary dividends paid to the parent, so there's nothing to adjust in column I. In column J, we can see that we're eliminating those intercompany transactions we talked about. So we've got the balances that are being eliminated here and here. You can see that the sales between the parent and the subsidiary have been eliminated, as well as those management fees and the interest income. And so here they are being eliminated, the management fees and the interest income. Columns K and L are used to eliminate profit and opening inventory, in which case we didn't have any in this particular question. So we move across to the balance of the adjustments. And in column M, you can see that we have to adjust for the inventory still held by the subsidiary that was sold to it by the parent, as well as the deferred tax implications associated with that. The next adjustment we have is in column P, where we have to eliminate the land sale transaction between the subsidiary and the parent. So that gain of $20,000 deferred, as well as the tax that would have been paid, until that land ultimately gets sold outside of the consolidated group. And then finally, we've got the depreciable assets, and there was no transactions over here to report. We move over to our consolidation and our reconciliations. You can see that I really don't have anything to compare these against, but I can see that my deferred taxes actually agrees to my Schedule G down below, and my deferred tax balance of $12,000 is made up of the $4,000 from the profit and ending inventory, as well as the $8,000 on the deferred land gain recognition. You can see that the parents' common shares have carried through, and they are in fact the common shares of the consolidated entity. Our retained earnings schedule balances to the reconciliation, $133,000. That can be reconciled in Schedule I at the bottom. And here we are down in Schedule I, and we can see the $133,000 consolidated retained earnings. And keep in mind, this is at the beginning of the year. And then we have our minority interest, which is also reconciled separately down below, and you can see that that agrees, giving us a total consolidated net income of $124,000, of which $3,000 belongs to the non-controlling interest, and $121,000 would be allocated to the common shares of the parent corporation. So as you can see, everything basically reconciles and our consolidation is complete. Now before we go, let's just throw in one more variation, because it's very common to see situations where the subsidiary actually pays dividends up to the parent and the non-controlling interest. So let's just pretend in this circumstance that the subsidiary actually paid $20,000 of dividends. Again, we'll have to adjust our retained earnings for that payment of dividends by subtracting off the $20,000. Adding it there, our trial balance balances. But now part of this $38,000 in investment income actually came from the subsidiary. And to adjust for that, we now need to go down into our Schedule G straight eliminations and adjust for the dividends received from the subsidiary. So the parent's portion would be $20,000 times 70%. So that there's $14,000. And let's just see how that gets eliminated in the worksheet. And now you can see in our worksheet where the $20,000 in subsidiary dividends are eliminated, $6,000 being allocated to the non-controlling interest and $14,000 being eliminated from the net income of the consolidated entity. So there you have it, your consolidated trial balance from which you can now prepare the consolidated financial statements. Now this question would typically take students about 90 minutes to do by hand. Using this template, it took, what, 10 minutes? Think of all the time I've just saved you to spend at the campus pub. Of course, I'm just kidding. Even if everything works out the way it's supposed to, you still need to understand the adjustments and the reconciliations. I doubt that you'll be able to bring this template into your exam, so be sure to study the schedules that I've built here for you and understand the flow of the information. Until next time, don't stop till you get to the top. When you get to the top, don't stop.